So I've got a good one for you today. Hopefully I'm going to make this actually one of my best videos this year on YouTube. And today we're going to talk about why so many people are now set up to fail in the stock market. And I've seen this in a few places, comment section, other places, on forums, comment boxes. Just the mindset of how poorly some people are actually going to do when we go from this bear market into a bull market, and see how many people are in a bad position, how bad of a position they have set themselves up for to get the returns, how this negative market has really affected them. And we're going to talk about this today, and hopefully you find this video very helpful. So at the moment we are in a bad place in the market, and that bad place in the market has really affected people's mindset. The bear market has changed investing strategies, and some of the investing strategies that have now been put in place are very much strategies that are going to underperform in the next few years when we move into a better place. Some of the investing strategies now are based on ultra defensive plays and making sure that people are in stocks that have potentially lost volatility, which isn't a bad thing, but have maybe gone extremely defensive, or into stocks that potentially don't do anything on a downward trend, but at the same time when we go into an upward trend, they are massively going to underperform the market. We've got people trying to time the market. People have kind of gone from into a place where, oh yeah, I'm a long-term investor, I'm always going to buy these stocks, to, oh, this stock's gone from $20 down to $10, I'm just going to sell out of it, or I can now time the market. And we're seeing people flip-flop out of positions, and people not really focus on the long-term game plan. And the reason why is because long-term investing is easy to do in a bull market. Everyone's a long-term investor in the bull market. How many people do we see on this YouTube scene saying, oh, I'm a long-term investor, and now we hit a bear market, and you see them faces on them businesses start to get actual tested. It's been frustrating to see fundamentals of your business performing absolutely amazing, but the share price still goes lower. It's awful, and you've seen so many people now have that tested on them and are not able to still stay in them positions, and don't really have an idea why they own that business and why that business is going to do well in the next few years. So hopefully this video is helpful for you and realizes what you need to do as an individual stock picker to perform well in the next few years. Now what I'm going to be doing is I'm going to be taking a lot of this from Peter Lynch. And Peter Lynch is a great investor. He is actually one of the investors that, if you are an individual stock picker, you really want to focus on this guy. He kind of tries and goes from the point of view of an individual investor can outperform the stock market, and he's got some fantastic books out. This is my favorite, and some of the stuff I'm going to be using today is from that book, and it shows you what you need to be doing as an individual stock picker to outperform the market. And some of his quotes can be like this: if you invest 1,000 in a stock, all you can do is lose 1,000, but you stand to gain 10,000 or even 50,000 over a time if you're patient. This is so true. The amount of people that I see get caught up because they have one stock that has self-destructed, and like, oh, I had 1,000 in stock and it's down 1,000. So what? You know, it sucks. I agree, it sucks. But the thing is, as long as you have a portfolio and you have good businesses, and you can't always predict the winner, but as long as you have some amazing stocks, that 1,000 for the other stock can end up into 10,000. You can have that one stock that easily makes up for that one stock that lost 1,000 that you invested in. But if the other one stock you had in 1,000 in goes to 10,000, you easily make up for them losses. And the upside for long-term investors is so high. You know, as a long-term investor, you can have stocks that 2x, 3x, 5x, 10x, 15x. There's that much potential in the long term. The only downside you have as a long-term investor is that you can lose, that 1,000 goes to nothing, but the potential for 1,000 to go even higher on the upside is unbelievable. This is such a good statement, and that's what I've seen a lot of people make a mistake of recently. Bargains are the holy grail of a true stock picker. We see the latest correction not as a disaster, but as an opportunity to acquire more shares at low prices. This is how great fortunes are made over time. So true. The amount of times I've seen people say that this stock's gone from $20 down to $10 and go, oh, it's a terrible stock because the share price has gone down $10. is unbelievable. That could sometimes be the true because the stock is performing not so well. But so many times stocks will lose half the value for no reason, and quite often they can be the best opportunities in the stock market. The amount of times I've talked about a stock and it's gone, say it's gone down 50%, and people go, "Oh, look, it's a terrible stock," and it's like, it's not though. Just look at the fundamentals. This is actually a really good opportunity. And how many of them will you see, prove to be, really good opportunities in the long term? I love this one as well. In the business of investing, if you're good, you're right 6 out of 10 times. You're never going to be right 9 times out of 10. This is what I love. This is even Peter Lynch going, when you're an investor, you have to be prepared. You are going to take losses on the way. And even if you get 6 out of 10 right, you're still doing pretty well. I mean, 9 out of 10 is absolutely fantastic. This is what you've got to realize as an investor. You just have to be right more times than you're wrong, and you will be a very good investor. And that's obviously a key thing that people struggle to accept. You are going to be wrong some of the times, and you just have to get over it and move on and get ready for the next opportunity. And one more I just wanted to add in. But my system for over 30 years has been this. When stocks are attractive, you buy them. Sure, they can go lower. I bought stocks at $12 that went to $2, but then they later went to $30. Unbelievable how true that statement is right now. How many times have you seen a stock in this last year that you think is, at $12, it's a good buy. It could potentially come $30. And then it goes down to 10, then 8, then 6, then 4, and then 2. So many times you've seen this happen, and like I said, as long as it's a quality business, it will return to a good share price. I thought this was really important to see right now. And they're just some of my favourite quotes that I wanted to share with you guys. That's enough Peter Lynch quotes for today. There's some more on that page if you want to read them, but honestly, such a good guy to listen to read about. Honestly, really good. You need to do research on him if you aren't. But this is what I wanted to talk about, is that so many stock pickers are in a bad place right now because a lot of their mindset has been affected rather than focus on the long term. And if you are a stock picker, you need to have winners to beat the index. That is key. There's no point having stocks that are just, steady performers completely, because you're not going to outperform the index. If you are going to be very defensive, then you might as well just buy the index. There's no hard work. You deal with no volatility. You're going to get basically the same sort of returns. And investing in the index is a really good thing. It's better than doing nothing with your money. You're still going to get really good returns, and it'll just save you a lot of the work. So for a lot of investors, buying the index makes sense. But if you're a stock picker, you do need to achieve winners. That is the key thing. And people have seemed to be put off with the higher risk stocks because they've been killed so much. However, those are the stocks that you need really to have a good performance and to perform well as an individual stock picker. And the big thing is, as a stock picker, if you open yourself up as a stock picker, you have to be aware what Peter Lynch shared right there. You can have losers, and you will take losers. As an individual stock picker, you will have to take on that risk a little bit more than buying an index, and you will get losers from taking on that risk. But to outperform, you don't need to do that much. You only need to have one amazing winner, that one stock that gives you let's say a 5x to 10x return. If you get that one stock that does a 5x to 10x in 5 years, that is all you need as a stock picker to outperform the index. And that's what you need to do as a stock picker. If you want to make stock picking worth your while, if you want to outperform the market and the index, and actually that time that you put in and that hard work you put in, to make it worthwhile, unfortunately you do need to have a stock that outperforms the market, and that will vastly improve your gains. And that's personally for me as well, how I have beaten the indexes in the last few years, is by having that performer that outlifts your whole market up, whether that be the likes of InMode, whether that be the likes of Tesla, for example, Pinterest. You've got to have a multi-bagger to help you lift your portfolio up, and people at the moment seem to be forgetting that if you are an individual stock picker. Now, the page I'm actually going to use from here is a page in this book that I just showed you, which is One Up on Wall Street. And there's actually a page on here. I'm going to show it to the camera. I'm really sorry if this is a really bad quality of image. But it's page 34 on this book right here. And there's a chart of a stock market portfolio, and I've written it out here. So Peter Lynch uses this portfolio here. And there's a couple of stocks, as you can see down here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 stocks. And in this portfolio, there's a stock that brings in, over a few years, 18%, negative 8%, 60%, 58% positive, 9.5% negative, 62% positive, 22% positive, 33% positive, negative 38%, negative 36%. So you can see here there's some good winners in the portfolio over the few years. There's some negative stocks in those few years. That's what happens in the stock market portfolio. You're going to have some winners, you're going to have some losers in that portfolio. You have some stocks that generally, don't perform that well at all. And that's why you need a diverse portfolio. Now, this portfolio here returned 30%, and the S&P in the same time frame returned 40%. So as a stock picker, if you return 30% compared to the S&P's 40% in those few years, obviously as a stock picker, you're like, what's the point? I've done all this work, I've took all this risk on, and I'm coming out worse than the S&P 500. I should have just put it in the S&P 500 and I would have done better. And that's what's key as a stock picker. If you just have average returns, you're not going to do that well. And the key is to get that stock that performs absolutely amazing. Now, if you add Stop and Shop into this portfolio, which returned 900% in that time frame, if you add that into this portfolio now returned 110%, way outperforming the market. Unbelievable return. Everyone looks, if you could do that compared to the S&P's return, yeah, you know what you're doing. You're a good stock picker. And that's the key of getting one of these, a multi-bagger, whether that be, even, a 500% return. That is the difference of having a portfolio that outperforms the index, that makes it worth it as a stock picker. And that's generally what you need to do, unfortunately. If you're a stock picker, you need to have that little bit of risk where you can afford to take on some losses, but you do need to have a stock that does really outperform the index. And that's what that one stock can do. That one stock can make up for the 1, 2, 3, 4, the 4 out of 10 bad performing stocks. And linking it back to where I was at this video today is set up to fail. So many people are, staring at defensive plays, not looking at the opportunities out there where there's fantastic stocks. There's fantastic stocks on sale that are giving you these opportunities, and people are looking at them in fear, potentially selling out positions, don't know what they're on or what they're buying at the moment, and there's these opportunities out here to perform. I think a few people are so caught up on losers that they're not focusing on what will give them the returns in the longer term. And that's personally for me where I'm at with my investing portfolio. Obviously I have a portfolio, and in my portfolio I'd say I have about 30 stocks at the moment. And in those 30 stocks that I currently have, I expect probably, my aim is to have about 3 if I can, but I would say that between 3 to 5, maybe 6, 3 to 6 of them stocks that I own in that 30 portfolio, I know are probably not going to, work out. That's unfortunately, what we talked about here from Peter Lynch, is that, you are going to have stocks that don't work out. And, I'd say that ideally if I can only have 3, that would be ideal. Obviously 0 would be absolutely amazing, but I am mentally prepared that at the end of the day as an investor, you are going to have some stocks that don't work out. But in those 30 stocks, I know that I need to hit some stocks as a stock picker that perform absolutely amazing and massively outperform these indexes to get really good returns. Now, obviously in my head, I've got the idea of the stocks that I think will do that in the next, 2, 3, 4, 5 years. And the key thing is for me to be worth my time as a stock picker, in those 30 stocks, I need a good 3 to 5 to be my Stop and Shop. If that doesn't happen, there's no point me being a stock picker. No point me. If I can't beat the index, there's no point me being a stock picker. I might as well just put all my money in the S&P 500 and I don't have to do any work. It's nice and easy, no research. I might as well do that. And that's what people are forgetting. That is the ultimate goal as a stock picker. There's no point being a stock picker if you can't beat the S&P 500. You might as well just buy the S&P 500. So as a stock picker right now, there's a lot of stock pickers that are set up to fail. You're set up to fail, because if you want to be in the longer term outperforming the S&P 500, and you'll especially see this when we move back into the bullish years, you need to be picking winners, and you need to be picking stocks that outperform the index, especially a Stop and Shop. And if you can't do that, there's no point investing in individual stocks. And that's what I've always tried to do. And right now we're going through a bear market. There's opportunities in sale and on sale, and I'm trying to pick up my Stop and Shop. And I've got a good idea which ones they will be in the next few years. And that's what I thought is really important to say, why so many people are going to fail. Because when we move out into a bearish, out of this bearish market into a bullish market, how many people haven't positioned themselves to outperform the market? There's a lot, in my opinion. There's a lot who have changed their styles, lost conviction on stocks that they potentially shouldn't have lost conviction on, maybe giving up on stocks just because it's gone from $20 down to $10. Might not be a bad company. You might be getting a really good opportunity on sale here that when you look back in the next few years, you go, oh, that was actually a Stop and Shop on sale and I missed out on it. So yeah, just hopefully that video is a little bit useful and something a little bit different for you guys today, and you enjoyed this sort of style of video anyway. I wanted to try to be a really good video today, because I thought this was actually a really good point to make. So thanks for watching, and I'll catch you in a bit.